Get out now. If you are in the stock market, if you have your savings, your retirement, your future tied up in equities, I am telling you to get out now. Sell everything. What is coming is a storm unlike anything we've seen in our lifetimes. The signs are all there for those willing to look. The debt, the inflation, the geopolitical instability, it's a house of cards, and the slightest breeze will bring it all crashing down. People who are holding on will be wiped out. This is not a drill. This is not a correction. This is a reckoning. Your financial survival depends on your willingness to act immediately. Now, if you ever hear me say anything like that, you can be 100% certain of one thing: you are listening to a deep fake. It's not me. It will never be me. And the person who created it is trying to do the one thing that will destroy your wealth faster than any market crash. They are trying to make you panic. The title of this video promised you a final warning. Well, you're going to get one, but it has nothing to do with getting out of the market. In fact, it's the exact opposite. My final warning, if I only had one left to give, would be this: beware the purveyors of fear. Beware the people who tell you they can predict the rain. Beware the siren song of market timing, which calls to you from the rocks of financial ruin. The most dangerous thing in the world for an investor is not a bear market. It is the belief that you can successfully navigate in and out of it. The chilling reality is that the biggest threat to your financial future isn't sitting in the boardrooms of Wall Street or the halls of the Federal Reserve. It's sitting in your chair right now. It's the person looking back at you from the mirror. It's the natural human tendency to become terrified when others are terrified, and euphoric when others are euphoric. For more than 80 years, I have watched people try to dance in and out of the stock market. They sell after a big decline because they're scared, and they buy after a big rally because they're scared of being left out. They are consistently buying high and selling low, a surefire recipe for disaster. And they do it because they think they can predict what's coming next. Let me be clear, in my entire life, and in my partner Charlie Munger's entire life, we have never made a decision based on a forecast about the economy or the stock market. Not once. We have seen depressions, world wars, oil shocks, pandemics, and financial panics. We have seen interest rates at 15% and at zero. We have seen presidents come and go. And through it all, we have done one simple thing. We have continued to buy pieces of wonderful American businesses at sensible prices. Today, I'm going to give you the mental framework that has allowed us to do that. It's a framework that turns market volatility from your enemy into your friend. It will teach you how to think about stocks not as flickering symbols on a screen, but as what they truly are: fractional ownership of a business. We will talk about the one fictional character who can make you a better investor than any Wall Street analyst. We will discuss the concept of a moat and why it's the most important thing to look for in a business. And I will tell you the story of a few extraordinary businesses that illustrate these principles in action stories that contain more wisdom than 1,000 textbooks on finance. If you stick with me, you will not learn how to predict the market. You will learn something far more valuable: how to make it so you don't have to. You will learn to ignore the noise, the fear, and the hype. And you will learn how to build real, lasting wealth, not by trying to get out, but by knowing when and why to get in and stay in. That is my real warning. Don't let anyone scare you out of participating in the greatest wealth-generating machine in history. Let's start with the absolute foundation. If you get this one thing right, everything else falls into place. When you buy a stock, you are buying a business. You are not buying a lottery ticket. You are not betting on a number. You are becoming a part owner of a company. If you were to buy a local farm or an apartment building in your town, how would you think about it? You would think about its long-term earning power. For the farm, you'd think about crop yields and the price of corn. For the apartment building, you'd think about rental income and maintenance costs. You would be a business owner. You would not get a quote on your farm every morning and decide to sell it because you heard a rumor that soybean futures were down 0.5%. That would be absurd. Yet, because the stock market provides a minute-by-minute quotation for millions of businesses, people feel an overwhelming compulsion to act on that information. This liquidity, which ought to be a tremendous advantage, becomes a terrible curse. It turns investors into speculators. What's the difference? It's the difference between night and day. An investor looks at an asset and asks, what will this produce over its lifetime? A speculator looks at an asset and asks, what will somebody else pay me for it tomorrow? The investor focuses on the output of the business. The speculator focuses on the price of the stock. It is a fundamentally different game. I am not a stock picker. I am a business picker. To help you adopt this mindset, my mentor, the great Ben Graham, invented a character who should be your constant companion in your investment life. His name is Mr. Market. Imagine you own a piece of a wonderful business and you have a partner, Mr. Market. He is a very peculiar fellow. Every single day he shows up at your door. He is a very obliging partner. He tells you what he thinks your interest in the business is worth, and he offers either to buy you out at that price or sell you his interest at that same price. The interesting thing about Mr. Market is that he is a manic depressive. Some days he is in a state of wild euphoria. He can only see a future of endless prosperity. The business is perfect, the economy is perfect, everything is perfect. On those days, he will name a ridiculously high price for your shares. He'll offer you far more than the business is truly worth. Other days, he is in the depths of despair. He is consumed by fear and pessimism. The business is struggling, the economy looks uncertain, the headlines are full of doom. On those days, he'll quote a price that seems unreasonably low, offering to sell his share for far less than its true worth. Now, here's the key point. Mr. Market doesn't care whether you accept his offer or not. If you decline, he isn't upset. He'll simply return the next day with a new proposal. His role isn't to instruct you, it's to provide options. A disciplined investor understands this dynamic. Mr. Market's shifting moods aren't signals to follow, but opportunities to evaluate. You sell to him when optimism drives prices too high, and you buy from him when pessimism pushes them too low. but you will never ever let his mood dictate your own. You will form your own opinion of the business's value based on the facts, and you will only transact when his price offers you a significant advantage. The stock market is Mr. Market. The daily news, the talking heads on television, the panic in the headlines, that is all just the babbling of your manic depressive partner. The get out now crowd is simply Mr. Market in one of his deepest funks, and the you can't lose crowd from the height of a bubble is Mr. Market in a state of manic glee. To be a successful investor, you must be able to psychologically detach yourself from the crowd. You must be able to think independently. This means you must learn to see bad news as a good thing. For the net buyer of stocks, which is what most people are, saving for retirement over many decades, a lower market is a wonderful thing. It means the businesses you are buying are on sale. Think of your favorite store. Do you get upset when they announce a 50% off sale? Of course not. You get excited. You should feel the same way about the stock market. When others are desperately selling, that is your 50% off sale. That is when you should be buying with enthusiasm, provided you are buying pieces of good businesses. This sounds simple, but it is the hardest thing in investing. It requires a temperament that is immune to the contagion of fear and greed. As I've often said, you need to be fearful when others are greedy and greedy when others are fearful. This is not a market timing formula. It's a psychological discipline. It means you buy businesses when they are out of favor, when pessimism is widespread, and you are cautious when everyone is celebrating and prices are sky high. The past few years have been a perfect example. During the pandemic panic in March of 2020, Mr. Market was in a full-blown psychotic episode. He was offering to sell the world's greatest companies at prices that made no sense. And it was a once-in-a-decade opportunity. But most people were paralyzed by fear. They were selling, not buying. A year later, with speculative fervor running wild in certain corners of the market, Mr. Market was back, this time wearing a party hat and offering to buy anything at any price. That was the time for caution, not for greed. So, my first and most profound warning is this: master your own mind. Do not let Mr. Market's moods become your own. See market declines as opportunities, not catastrophes. If you cannot do this, you are destined to get poor results, no matter how brilliant your analysis is. Now, assuming you can achieve this mental fortitude, how do you decide what to buy? This brings us to the practical toolkit of the business picker. It revolves around three core ideas: the circle of competence, the economic moat, and the margin of safety. First, the circle of competence. This is one of the most vital concepts in investing. You don't have to be an expert on thousands of companies. You don't even have to be an expert on 100. You only have to be able to understand the businesses you invest in. The size of your circle is not important. Knowing its boundaries, however, is crucial. I know how to evaluate certain kinds of businesses. I understand the economics of brand loyalty. A person who chews Wrigley's gum is not likely to switch to another brand to save a nickel. A family that grew up with Coca-Cola has an emotional connection to it that is incredibly difficult for a competitor to break. I understand the business of insurance, where we collect money up front, the float, and pay it out later. and get to invest that float in the meantime. These are businesses inside my circle. What's outside my circle? For a long time, it was technology. I didn't understand the competitive dynamics of the software industry in the 1990s. I didn't know which company would win, so I stayed away. It wasn't a mistake for me to miss Microsoft. The mistake would have been to invest in it without understanding it. That would have been gambling. Your job as an investor is to honestly assess what you know and what you don't. Do you understand the banking industry? Do you understand the railroad business? Do you understand how a pharmaceutical company makes money? If you don't, that's fine. Just put it in the too tough pile. There are thousands of other companies. Wait for one that you can understand. As the great baseball player Ted Williams said, the key to hitting is to wait for the right pitch. In investing, there are no called strikes. You can stand there at the plate all day, and Mr. Market can throw you pitch after pitch, tech stocks, biotech stocks, emerging market stocks. You don't have to swing. You can wait for that one perfect pitch, right in your sweet spot, a business you understand completely. Then, and only then, do you take a swing. The second idea is the economic moat. When you find a wonderful business, you have to ask yourself what protects it from competition. Capitalism is a wonderful system, but it is brutal. If you have a business that is earning high returns on its capital, like a profitable castle, you can be absolutely sure that an army of competitors is going to march over the hill and try to take your castle. Your only defense is a moat, a durable competitive advantage that protects your profits. What does a moat look like? Sometimes it's a strong brand name. Think of See's Candies, a company we've owned since 1972. When you give a box of See's for Valentine's Day, you are not just giving chocolate, you are giving a message of quality and affection. You are not going to risk that message by switching to brand X to save $1. That brand loyalty gives See's pricing power, the ability to raise prices without losing customers. That's a powerful moat. Sometimes the moat is a low-cost advantage. This is the story of GEICO. For decades, GEICO has been able to offer lower insurance premiums because it sells directly to the customer, cutting out the cost of agents. Competitors who are locked into the agent system simply cannot match GEICO's cost structure. That is a structural, sustainable advantage, a wide moat. Other moats include patents, which protect a drug company, or network effects, where a service becomes more valuable as more people use it, like American Express. The key is that the moat must be durable. It must be something that can withstand the attacks of competitors for many years. A business without a moat is a risky proposition, no matter how cheap it looks. It's a castle built on sand. The third and final idea in our toolkit is the most important of all. It comes directly from Ben Graham. It is the three most important words in investing: margin of safety. This is the principle that protects you from the uncertainties of the future. You never buy a stock just because you think it's worth a little more than you're paying. You must insist on buying at a price that is significantly below your conservative estimate of its intrinsic value. Intrinsic value is a simple concept. It is the discounted value of all the cash that a business will generate over its lifetime. The calculation can be complex, but the idea is not. You are figuring out what the business is truly worth. If you calculate that a business is worth $100 per share, you don't buy it at $98. That's not a margin of safety. You wait. You wait until Mr. Market has one of his fits of terror and offers it to you for $50. When you buy a wonderful business at a 50% discount to its intrinsic value, you have an enormous margin of safety. Many things can go wrong. The economy could stumble, a new competitor could emerge, your own analysis could be slightly flawed, and you will still likely get a decent result. If things go right, you will get a spectacular result. The margin of safety is the bedrock of value investing. It is what separates investing from speculation. Without it, you are just gambling on the future. With it, you are making a sound business proposition. Let's look at a real-world example of how these three ideas, circle of competence, moat, and margin of safety, come together. Back in the early 1950s, when I was just getting started, I was looking through a manual of insurance companies. I came across a small company called GEICO, the Government Employees Insurance Company. It was in the insurance business, which I was starting to understand. So it was within my circle of competence. I took a train to Washington, D.C. on a Saturday to visit their headquarters. The building was closed, but I pounded on the door until a janitor let me in. He pointed me to the one person who was working that day, a man named Lorimer Davy Davidson. Davy wasn't the CEO, but he was a brilliant insurance man, and he spent the next 4 hours explaining the business to me. He explained GEICO's moat. At the time, most insurance companies sold through agents who took a hefty commission, maybe 15% of the premium. Geico sold directly to a select group of customers, government employees, through the mail. This cut out the agent and allowed them to offer much lower prices for the same coverage. This was a massive, sustainable, low-cost advantage. Their competitors were structurally unable to copy it without alienating their entire sales force. It was a brilliant business model. And the margin of safety? At the time, the company was earning good money, growing rapidly, and yet the stock was not widely followed. It was selling at a price that was extremely reasonable relative to its earnings and its spectacular growth prospects. It was a perfect pitch, right in my sweet spot. I put about 3/4 of my net worth into it at the time, and it was an enormous success. Decades later, in the mid-1970s, GEICO got into trouble. They had made some terrible mistakes in pricing their policies and were on the verge of bankruptcy. Mr. Market, who had once loved GEICO, was now convinced it was worthless. The stock, which had been over $60, fell to $2. But I knew the business. I knew that the fundamental moat, the low-cost advantage, was still there. It had been obscured by bad management, but it hadn't been destroyed. A new management team came in, led by a brilliant executive named Jack Byrne, and they began to fix the problems. This was another opportunity, a 1-foot hurdle. The business was still great, and now it was being offered for practically nothing. Mr. Market was having a nervous breakdown. So Berkshire started buying. We bought and bought and bought. We eventually ended up buying half the company for $45 million. In 1995, we bought the other half for $2.3 billion. Today, GEICO earns that much in profit every few months. The Geico story is a perfect illustration of the principles at work. It was a business I could understand. It had a giant durable moat. And on two separate occasions, decades apart, Mr. Market offered it to me with an enormous margin of safety. We didn't predict the economy. We didn't time the market. We simply analyzed a business, recognized its value, and acted when the price was silly. Now, let's contrast this with the things that get people into trouble, the things that my get out now warning is really about. The real warning is to get out of a certain way of thinking, get out of the prediction business. If you spend your time trying to guess the next move of the Federal Reserve or the next GDP report or the next election outcome, you are playing a game you cannot win. There are too many variables. The world is too complex. You are wasting your most precious asset, your time and your mental energy. Focus that energy on what is knowable and important, the long-term economics of a business. Get out of the hot stock business, the stock that is the talk of the cocktail party, the one that has gone up 500% in the last year. That is not an investment opportunity. That is a speculation. By the time you hear about it, the smart money has already been made. Buying something just because it's going up is called momentum investing. It works until it doesn't. And when it stops working, the crash is brutal. Bubbles are an inevitable part of the market, but you don't have to participate in them. As Isaac Newton said after losing a fortune in the South Sea bubble, I can calculate the motion of heavenly bodies, but not the madness of people. Get out of the complexity business. Wall Street loves complexity. They invent complex products with fancy names, collateralized debt obligations, credit default swaps, because complexity creates fees. For the investor, complexity is the enemy. If you can't explain in simple terms why you own something, you probably shouldn't own it. The best businesses are often the simplest. Selling soap, selling soda, selling insurance. These are not complicated businesses. Their beauty is in their simplicity and their durability. And finally, get out of the business of paying high fees. The investment industry is a giant machine designed to transfer money from the client's pockets to the manager's pockets. A 1% or 2% annual fee might not sound like much, but over an investment lifetime, it is a killer. It can consume a third or even half of your total return. The low-cost index